If you've been watching the crypto world lately, you just saw something absolutely wild. A crash that didn't just rattle the market, it sent shockwaves, wiping out fortunes almost overnight. This wasn't just a little dip, folks. This was a record-breaking collapse. So today, we're going to unpack the perfect storm of politics, policy, and pure panic that made it all happen.
So just to put this into perspective, let's start with a number. $200 billion. That's how much value was just erased from the market in a matter of hours. It's a staggering figure, but honestly, it doesn't even begin to tell the whole story.
Yeah, because behind that giant number, there are real people. And this quote from an analyst, wow, it just captures the human cost of it all. Thousands of longtime traders going from millions to literally zero within the span of a couple of hours. Think about that. This wasn't just, lines on a chart going down. This was people's life savings, their futures, just vanishing in an instant.
Okay, so what we're talking about here was the single biggest liquidation event in the history of crypto. I mean, this wasn't just a bad day at the office. It was a full-blown, catastrophic collapse. And to really get it, you have to understand that it wasn't just one thing. It was three key forces that collided to create this perfect storm: a political trigger, a really fragile market, and the wild mechanics of the crash itself.
All right, let's start with the spark that lit the whole thing on fire. A lot of the immediate panic, the "oh my god, sell everything" moment, can be traced back to a single political announcement that just happened to hit the market at its absolute weakest point.
And this was the headline that did it. The sudden announcement of a new 100% tariff on Chinese goods. That just sent a massive wave of fear rippling through not just crypto, but the traditional markets too. Everyone started worrying about a brand new aggressive trade war. And when that happens, what's the first thing investors do? They dump their riskiest assets. And crypto was right at the top of that list.
So, you might be asking yourself, why would a Trump announcement cause this much chaos in the crypto world? Well, take a look at this timeline. It shows his complete 180 on the whole subject. I mean, he went from calling Bitcoin a scam back in 2021 to promising to make the US the crypto capital of the planet just a few years later. Because of that pro-crypto pivot, the market now hangs on his every word. It makes his policy moves incredibly powerful, for better or for worse.
And this, of course, is where things get really controversial. Sources started pointing to a series of, let's just say, troubling events. For one, a whale trader somehow made a mind-boggling $192 million profit by shorting crypto minutes before that tariff announcement became public. At the very same time, critics are alleging that the SEC has been neutering its own crypto enforcement. And then you have reports surfacing about the Trump family's financial ties to certain tokens. You put all that together, and it's absolutely fueled some serious allegations of insider trading and corruption.
But look, a political spark, even a big one, doesn't cause a collapse of this size all by itself. To understand why the market was such a tinderbox, we need to zoom out and look at the bigger picture, the macroeconomic environment that the U.S. Federal Reserve created. This environment had made the market incredibly fragile long before anyone even heard the word tariff.
Okay, so the easiest way to think about the Fed's interest rate policy is like financial gravity. When the Fed keeps rates low, money is cheap to borrow. Safe stuff like bonds pays you next to nothing. So, where does the money go? Investors chase higher returns in riskier assets, like crypto. But when the Fed jacks up interest rates to fight inflation, borrowing gets expensive. All of a sudden, those safe bonds offer great returns, and that gravity just pulls money out of risky assets like crypto and back to safety.
And this isn't just some abstract theory, right? We literally saw this play out in 2022. The Fed's rate hikes are what triggered that brutal crypto winter. The market honestly never fully recovered from that. So when this new tariff news hit, it wasn't landing on a strong, healthy market. No way. It hit a market that was already standing on really, really thin ice, just primed for a collapse. So we've got the political trigger, and we've got the fragile economic backdrop. Now, let's look at the third and final piece of the puzzle, the internal market mechanics that turned a simple panic sell-off into an absolutely unstoppable, record-breaking liquidation cascade.
It's like watching a row of dominoes fall, but at lightning speed. It all starts with that negative headline, right? That sparks the first wave of selling. But that selling automatically triggers forced sales for traders who are using high leverage. Suddenly, the price is dropping so fast that the safety nets, things like stop-loss orders, completely fail. The price just blows right past them. The big institutional players, the market makers, they see this chaos and they pull their money out to protect themselves. And just like that, liquidity evaporates. There's no one left to buy. And that's when you get the death spiral. A liquidation cascade that literally wipes out entire accounts in a matter of minutes.
Now, that key ingredient that just pours gasoline on this whole fire is a little thing called leverage. It's basically trading with borrowed money. It's a double-edged sword, you know? It can amplify your profits like crazy, but it can also magnify your losses just as fast. And in this crash, the record amounts of leverage in the system were what turned a bad situation into an absolute catastrophe.
And the result was just devastating, especially for the smaller altcoins. With all the major buyers gone and literally no one left to prop up the price, some of these coins dropped over 90%. 90! In minutes. The bottom didn't just get weak, it completely fell out of the market.
Okay, so after watching a storm like that, it's really easy to feel like this whole market is just one big rigged casino. We've talked about why it crashed, but what does that actually mean for you, for investors? I mean, how are you supposed to navigate an environment this crazy without getting totally wiped out?
Well, check out this chart. This is the Fear and Greed Index, and it basically measures the emotional state of the market. During the crash, this thing plunged all the way down to 17, which is deep, deep into extreme fear. Now, this is the point of maximum panic, right? It's where people make emotional, irrational decisions. But here's the crazy thing. Counterintuitively, history shows that these moments of extreme fear have often been the absolute best buying opportunities. The real challenge is just not getting swept up in the panic yourself.
So how do you take that emotion out of the equation? Well, one really popular strategy is called dollar cost averaging, or DCA for short. The idea is simple. Instead of trying to be a hero and time the market perfectly, investing a huge lump sum at the exact bottom, you just invest a fixed amount on a regular schedule. Could be $100 every week, no matter if the price is up or down. You just stick to the plan.
And this right here, this shows you just how powerful that simple strategy can be. This is a real-world example. If you had taken, say, $16,000 and invested it all in Bitcoin at the absolute peak in 2017, well, after 2 years of that brutal bear market, your investment would have been cut almost in half. Ouch. But if you'd invested that exact same amount using DCA, just $100 a week over about 3 years, that same portfolio would have grown to around $65,000. See? By buying consistently through the highs and the lows, you actually turn that scary volatility into your biggest advantage.
Look, at the end of the day, for most people, trying to time this chaotic market is just a losing game. A much more effective path is to create a disciplined, long-term plan, and then just have the guts to stick to it, tuning out all the noise from the short-term crashes and the crazy hype cycles.
So when you put all of these pieces together, the politics, the shaky macroeconomics, the absolutely brutal market mechanics, it really makes you ask a pretty fundamental question about what crypto even is at its core.
Is crypto a rigged game, a casino where insiders always win by profiting from chaos? Or is it the volatile, messy, but ultimately revolutionary frontier of a whole new financial system? After a crash like this one, it's pretty clear the answer isn't simple, and you know what? This debate is far from over.